From your home loan EMI to stock market sentiment and business borrowing costs, today's decision by the Monetary Policy Committee impacts everyone. The RBI today made it clear that while inflation is cooling, the road ahead still needs careful handling. So what exactly did the central bank decide? Let's break down the big takeaways from the latest Monetary Policy Committee meeting in simple and clear terms. The biggest headline first. The RBI has cut the repo rate by 25 basis points, bringing it down to 5.275%. This comes after months of keeping rates high to fight inflation. With price pressures finally easing, the RBI has now shifted its focus slightly towards supporting growth. For common borrowers, this decision could mean relief in loan EMIs over the next few months. Home loans, auto loans and business loans could become marginally cheaper provided banks pass on the benefit of this rate cut. However, the RBI has also signaled that it will move cautiously and will not rush into aggressive rate cuts. Even as it cut the repo rate, the RBI chose to continue with a neutral policy stance. This is important. A neutral stance means the central bank is keeping all options open. It is not promising a series of rate cuts, but it is also not ruling them out. Simply put, the RBI wants flexibility. If growth weakens further, it can cut rates again. But if inflation makes a comeback because of food prices, crude oil or global shocks, it can pause or reverse course. On the growth front, the RBI sounded confident. It has upgraded India's GDP growth outlook for the next financial year, now placing it at around 7% or slightly above. According to the RBI, India's economy continues to be supported by strong domestic demand, government spending on infrastructure, improving rural consumption and steady services sector growth. Despite weak global growth and export challenges, the RBI believes India's domestic economic engines remain strong and enough to keep growth steady. The RBI said the overall inflation outlook has turned much more benign in recent months. This improvement has come largely because of a sharp fall in food prices, better supply conditions, and stable core inflation. The RBI has also lowered its inflation forecast, bringing it closer to its medium-term target of around 4%. Apart from interest rates, the RBI also focused on liquidity, that is, the availability of money in the banking system. To ensure that banks have enough funds to lend and that markets remain stable, the RBI announced large-scale open market bond purchases and dollar-rupee swap operations. These measures are meant to keep borrowing costs under control, support credit growth, and prevent any tightening of liquidity as the economy moves into the next phase of recovery. The RBI has also acknowledged that global risks remain high. These include weak global growth, geopolitical tensions, uncertain crude oil prices, and volatility in global financial markets. While these external factors could affect exports, capital flows, and the rupee, the RBI said India is currently well placed to absorb global shocks compared to many other major economies. For borrowers, the policy could slowly translate into lower loan EMIs. For businesses, it could help in reducing borrowing costs and boosting fresh investments. For stock markets, easier liquidity and lower rates are generally seen as positive signals. And for the overall economy, this move is aimed at sustaining growth without letting inflation spiral again. To sum it up simply, the RBI has cut interest rates, it has kept its policy stance neutral, it has upgraded India's growth outlook, it has lowered inflation projections, and it has promised continued liquidity support. So with the rupee depreciating, do you think the RBI's economic policies will bring back the momentum in the Indian economy? What do you think of it? Share your thoughts with us in the comment section below.
If you like this video, then like, share and subscribe to ET Now.